Hammond Power Solutions ended 2025 navigating a specific mathematical disconnect. The company is managing a historic demand surge while simultaneously reporting a contraction in its profitability profile. Record annual sales reached $898.3 million Canadian dollars for the full year. That represents a 13.9% increase over 2024. Momentum was concentrated in the US and Mexico markets, where sales grew by 18.1% due to high volume in custom-engineered electrical solutions. The most aggressive indicator of future demand is the company's total backlog, which ended the year 122% higher than the prior year. In this split-screen chart, revenue scales upward on the left, while gross margins drop 250 basis points, or 2.5%, from 32.8% to 30.3%. The trend lines then morph into a massive bar chart, labeling data center expansion as the foundational driver. In heavy manufacturing, record demand and increased physical scale typically result in margin expansion. Standard economic logic suggests that unit costs should decrease as volume rises. This margin compression raises the question of whether the underlying economics of the business are under structural pressure. The fourth quarter data suggests this drop is a mechanical artifact created by the physics of rapidly scaling a heavy industrial footprint. Evaluating the company's true valuation requires looking past the headline margin percentage to diagnose the specific unit economics of this expansion. Isolating the margin drop requires a look at unabsorbed factory overhead. This refers to the fixed costs of a factory, like rent, base payroll, and utilities, that have not yet been offset by sufficient product output because the facility is still ramping up production. This accounting reality was visible in the fourth quarter, as the new $100 million Monterrey 4 manufacturing facility in Mexico came online ahead of schedule. Monterrey 4 was part of a larger capacity strategy: expansion at Monterrey 3, additional space in Guelph, and a new Dallas logistics hub. This timeline details the financial mismatch of a new factory opening. Fixed costs turn on immediately on day one. Revenue generation gradually follows over several quarters. The geometric gap between immediate costs and initial revenue represents the unabsorbed overhead zone. Under standard accounting procedures, these unabsorbed costs flow directly into the cost of goods sold. This creates a temporary drop in the gross margin percentage, dragging down the fourth quarter report despite the new capacity functioning as intended. Management expects this overhead absorption to normalize as factory utilization and product throughput ramp up by the second quarter of 2026. While these unabsorbed costs impacted the income statement, net debt improved from $28 million to $15 million by year-end through disciplined working capital management. Unabsorbed overhead represents the literal cost of future capacity before production reaches its optimal scale. Internal expansion costs were compounded by external macroeconomic shocks that hit the fourth quarter financial results. In August 2025, the implementation of Section 232 tariffs had a direct impact on the cost of finished goods. Section 232 is a U.S. trade policy that allows for tariffs on imported goods deemed critical to national security. Concurrently, volatility in global copper prices increased the raw material input costs for industrial transformer production. Heavy industrial manufacturing involves a pricing lag. When input costs spike, existing contracts and distribution channel structures prevent a company from adjusting prices instantaneously. This timeline illustrates the timing gap. August tariffs hit costs immediately, while defensive price increases were implemented a month later. The geometric gap between immediate cost increases and delayed price realization accounts for the secondary margin hit. Because industrial price changes take time to flow through distribution channels, the full benefit of the September hikes will lag into early 2026. While tariffs and copper costs impacted the fourth quarter, the successful execution of the September pricing actions suggests the company retains its long-term pricing power. The shift in revenue realization also stems from the specific composition of the 122% backlog surge. Historically, the company's backlog consisted of standard electrical products with a rapid turnover cycle of 6 to 8 weeks. The massive influx of custom data center projects has stretched the tenor of the backlog, the time required to fulfill an order and recognize revenue. These multi-year projects now account for nearly 30% of total sales volume. While this demand is locked into the backlog today, the revenue realization is deferred deep into 2026 and 2027. The company is absorbing upfront factory costs today to service revenue that will hit the ledger over the next 2 years. This alignment of unabsorbed costs, pricing lag, and deferred custom revenue creates a temporary mask on the company's true operational leverage. Management responded to these dynamics by signing a definitive agreement to acquire AEG Power Solutions for $365 million Canadian dollars. The acquisition adds approximately $326 million in revenue, over 780 employees, and 5 manufacturing facilities to the global footprint. This map shows how the deal breaks the company out of its North American concentration, establishing direct operations in European and Asian markets. The company is integrating complex power conversion systems, rectifiers, inverters, and UPS units directly into its portfolio. A rectifier is an electrical device that converts alternating current, AC, into direct current, DC. This shift allows HPS to capture a larger share of the value chain inside high-growth markets like transportation electrification and global energy transition. Additional minority investments in SmartD and Verdine provide further access to complete power quality solutions and identify facility-wide electrical issues. The AEG acquisition transforms HPS from a regional hardware manufacturer into a globally relevant integrated electrification provider. The most stabilizing asset in the AEG deal is a massive installed base of existing power systems already operational worldwide. This installed base creates a foundation for recurring aftermarket and service revenue. This stream of service revenue acts as a financial shock absorber, insulating margins during cycles where new industrial hardware orders may slow. The 250 basis point margin drop in the fourth quarter reflects the necessary friction of a company aggressively scaling its physical footprint. As the Monterrey 4 facility ramps to the level required to service the record 122% backlog, unabsorbed overhead will dissipate, allowing operational leverage to return. HPS is absorbing short-term accounting impacts today to build the capacity and strategic infrastructure required for the next decade of global digital electrification.